What is your role at Colbert?
I'm the chief economist and responsible for the fixed income part of the trust company, which means we're the guys that buy and sell, fixed income or bonds, build bond portfolios for other people. We manage about $20 billion on behalf of others.
So what's the purpose of your talk today?
Well, I will. There's three of us speaking, and my part is really to kind of set the stage for where we see the economy and why we are doing what we're doing with a typical balanced portfolio. So I'll set that up. We'll go on to Joe Williams, who's our chief strategist, and conclude with one of our research analysts who will talk specifically about kind of the things they're doing within the equity market.
So first of all, just to kick things off, all the markets have been pretty volatile over the past year. For novice investors like myself, is now a good time to get into the market or not?
Well, we think that it was a nice opportunity. The stock market peaked about October 3rd, declined substantially for literally till the day after Christmas, and we thought that was a pretty good opportunity to at least rebalance. And if you hadn't been in the market, it would have been a nice opportunity to get in. Now that things have rebounded quite a bit, but not entirely, we still see this as a very positive year, particularly after last year, where stocks were down and yet earnings were still growing. Typically when that happens, and it's only happened a few times, the next year that follows is a very good year.
One of the things that I've heard constantly from employers during my time down in Jeff City and even up here already is that employers are having a hard time finding workers. Columbia had an unemployment rate of 1.8% in December.
Yeah, in fact, all college towns are kind of like that. Right.
With unemployment so low locally and statewide, are there any negative effects of unemployment being so low?
Yeah, absolutely. I mean, when you look at everything in aggregate, we still think the economic expansion is going to last quite a bit because there's still excess plant and capital equipment. But what there isn't any excess of is labor. Now, one of the reasons for that, of course, is demographic, right? Where we've got older folks that are leaving the workforce faster than younger folks are coming in. So you don't have as growing a labor force pool. But secondly, the participation rate. If you took the key people that participate, ages 22 to 54, that's only about 78% of the population. That used to be 80% of the population. So this long, slow recovery is starting to draw some more people back into the labor force that might have left the labor force for whatever reason.
The Tax Cuts and Jobs Act really was a shot in the arm to the markets. But growth is expected to slow this year to about 2 to 2.5%. What forces are dragging the market?
Yeah, so last year's growth, which probably came in, and we still don't have the reported numbers yet, and in fact, they will revise those growth statistics 9 times before they're finally in the books. But the best take is the growth last year was about 3%, right? Maybe 3.1. This year it's projected to be much lower, and the reason for that is this. Last year's tax cut was an immediate boost, but you don't get that reboost this year. Secondly, there was some fiscal spending that went along with that, meaning some deficit spending by our government that propelled things forward, which gave us that 3% growth rate. That all begins to fade now this year. And so we're much more likely to get back to the 2.1% growth rate that we had prior to last year, which has been the